Well, the resilient economy and consumer have unexpectedly thrived through the Fed's tightening campaign so far. Defying expectations, the S&P 500 and Nasdaq both enjoying the best start to the year in 4 decades. More than a year after warnings of recession, one has yet to materialize. Is the market out of the woods? Well, according to our next guest, that's the Fed's choice. So joining me now is David Waddell, Waddell Associate CEO and Chief Investment Strategist. Good to have you. So break down this base case that basically says if there is a recession at this point, that's the Fed's choice.
Yeah, not only that, I don't think it really matters. And here's why. If you go back over the last 6 quarters, the economy's been kind of crawling anyway at a less than 2% rate, more like a 1% rate. We got a little bit better news in the revisions for last quarter. This quarter, maybe tracking around 1%. What's kind of interesting about this time period to me is we've been in such an abnormal environment for the last 3 years. Now we're sort of rotating into a normal environment, and that's making people uncomfortable. So normal GDP growth should be about 2%. Normal inflation, if you go back over history, should be about 3%, which is where we are. Normal interest rates should be about 4%, which is where we are on the 10-year. So quite slowly, we're reclaiming normal sort of one statistic at a time. So it may be that the economy tips into recession. Obviously, the soft landing case is growing, but even if it does, that mild recession scenario, I think, still holds. And I don't think it really matters. Let's not forget, we went into a mild recession in the first 2 months of last year, and people sort of didn't even call it recession. So I think the Fed has done its job, and natural forces have also played a role in getting inflation down, and that just eliminates the need for them to really crash this economy. So I think we're fine. We're sort of reclaiming normal, and that's what's encouraging people so much, because the reality is starting to come in as we knew it, which is a good thing.
So, I mean, still widely expected to see the Fed hike rates in July. But at that point, do you think that's it? Is that going to be just sort of a holding pattern for a while and then cuts, or is this a pause and a hike?
So they need to save face, and they've done a pretty good job, really, of setting expectations in the market for what they're going to do. When you look at that CPI report that came in at 3%, if you take shelter out of it, which is 40%, that's owner equivalent rent and rent, that report was 1.7%. So that's year over year. That's not inflation. I mean, that's even below target. Even at the core, if you reduce it, it gets down low. So the PPI that we got this morning was below expectations. So the economy, good news, is surprising to the upside, while inflation, good news, is surprising to the downside. So it's happening. They don't need to press the brake any further, I don't think, unless they really do want to focus entirely on the labor market and deal with the supply and demand imbalances there. It's still a tight labor market, but inflation is meeting the mark. So they'll go one more time in July because they told us they would. But after that, I don't really see any reason to go further unless we get some sort of spike, some sort of upside surprise, which I don't see right now. I think this trend is intact. It's really market friendly. It's very economically friendly. And that's the reason why you're seeing the rally continue.
And David, obviously, we're going to be coming into the thick of Q2 earnings season here. So with that in mind, I mean, there was a low bar for earnings. I mean, but the same low bar was set in the first quarter. But you seem to be more optimistic about this. Why is that?
Well, here's the thing. So right now, the estimates are that we'll lose 7% in terms of year-over-year growth in earnings. By the way, that's against Q2 2022, which was the top in earnings. So the entire drawdown, and this is probably the nadir, or at least analysts seem to think so, this quarter was 7%. Okay, that's not that big a deal. The reason I'm optimistic is last quarter, there was an enormous earnings surprise. And in fact, going into this quarter, we've seen more upside guidance than on average. And places of the market where you'd expect to see terrible earnings like financials are actually projected to grow. So the market, I think, has determined that earnings will likely come in a little bit better than expected. And by the way, that's old news because we're forward looking. So if we get past this, the economy stays afoot, and corporations have done a great job preparing for the recession that hasn't come, which is very supportive for earnings. Now we're talking about next year's earnings at 250. the following year's earnings at 270, and we're at 225 today. So if you apply reasonable multiples to that, either on forward or trailing, you can make a case, I'm not making a prediction, but you can make a case that this market still got another 20% to run based upon what's reasonable as far as earnings expectations going forward. So I think this quarter, we've had 3 year-over-year negative quarters in a row. This might be the end of that. But I'm expecting, again, that it comes in better than expected, and companies have signaled that to date. So it'll be down, and that's a bummer, but all that matters is that it comes in above expectations, and I think it will.
All right. Always great to get your insights. David Waddell there. Waddell Associate CEO and Chief Investment Strategist. Always good to see you. Take care.
Great to be with you. Thank you.